You downloaded the app. You've been meaning to do it for months, maybe years. Everyone around you kept saying the same thing. You need to invest. Your money is losing value. Start now. So you finally did it. You opened a brokerage account, typed in your information, verified your identity, and the app dropped you into a screen that looked like the cockpit of a plane you don't know how to fly. Tickers scrolling. Green arrows. Red arrows. Charts with lines going in 6 directions. Words you'd seen before but never understood. PE ratio. Dividend yield. Market cap. Expense ratio. ETF. REIT. Mid-cap growth. Large cap value. 500 options and 0 instructions. You stared at it for maybe 30 seconds. Then you closed the app, and you didn't open it again for a very long time. That moment, that exact moment of staring at a screen and feeling like everyone else got a manual you never received, is not a failure of intelligence. It's a failure of explanation. Nobody sat you down and told you what investing actually is. They just told you to do it and walked away. That ends right now. In the next 20 minutes, you are going to understand all of investing. Not the jargon, not the tricks. The actual thing, what your money does when you invest it. Where it goes, what it becomes, and why the simplest approach almost always beats the most complicated one. No finance degree, no spreadsheet. Just the real ideas, explained the way they should have been explained the first time. Here's the truth that makes all of investing click. Everything in investing comes down to 2 questions. First, what is your money actually doing when you invest it? Second, why does doing less almost always beat doing more? Those 2 questions have names. The first one is about the vehicles. The second one is about the strategy. By the end of this video, you'll understand both, and you'll see that they're connected in a way almost nobody talks about. But before we can answer either question, you need to see the world that created them. Imagine it's 1900. You work 6 days a week. You earn a decent wage. And every week you take what's left after food and rent and you put it in a box under your bed. You're being responsible. You're saving. 10 years go by. 20. You open the box and count it. Every dollar is still there. But here's the thing nobody told you. Those dollars don't buy what they used to. The bread that cost 5 cents now costs 12. The rent that was 15 a month is now 30. Your money didn't move. The world did. And sitting still made you poorer. That's the problem investing was built to solve. Money that sits still doesn't stay the same. It shrinks. Slowly, invisibly, like ice melting in the sun. You look at it, and it looks fine. The number hasn't changed. But what it can do, what it can buy, what it represents, that's getting smaller every single year. Saving money is like holding a glass of water with a tiny crack in the bottom. You can't see the water leaving. But come back in 10 years and the glass is half empty. So somebody, a long time ago, figured out the trick. What if, instead of letting your money sit there and lose value, you used it to own a piece of something that grows, something that makes more money over time, something that builds and expands and creates value, not gambling, not guessing, owning. That idea, ownership, is the foundation of all investing. Before you can understand any vehicle or any strategy, you need to understand this one concept, because everything else is just a variation of it. Here's what ownership means in the simplest terms possible. When you invest, you are buying a piece of something real, not a ticker symbol, not a line on a chart. A real thing that exists in the world, that produces value, that generates money. It might be a piece of a company. It might be a loan you made to a government. It might be a slice of a building. But in every single case, you are an owner. You put money in. You got a piece of something back. And if that something does well, your piece becomes worth more. Think of it like a pizza with 100 slices. You buy one slice, the pizza grows, your slice grows with it. You didn't bake the pizza, you don't run the kitchen, you don't even know the recipe. But you own a piece, and that piece gets bigger as the whole thing gets bigger. That is investing. That is all investing is. Every stock, every bond, every fund, every piece of real estate. It's all just different ways of buying slices of different pizzas. Now that you have that foundation, the two questions become easy. Here's what the vehicles do. The vehicles are the answer to the first question: what is your money actually doing when you invest it? There are really only 4 things you can own, and once you see them, every investment product in the world is just a combination of these 4. The first vehicle is stocks. When you buy a stock, you are buying a tiny piece of a real company, not a bet that the price will go up, an actual ownership stake. If the company makes money, you make money. If the company grows, your piece grows. You are a part owner of that business the same way you'd be a part owner if you and 4 friends opened a coffee shop and each put in equal money. The only difference is scale. Instead of 5 owners, there might be 5 million. Instead of a coffee shop, it might be a company that makes phones or sells groceries or streams movies. But the principle is identical. You own a piece. The piece has value. The value changes as the company changes. Now here's what most people miss. The price of a stock moves every single second. It goes up. It goes down. It looks chaotic. But every price movement is just millions of people voting in real time on what they think that piece of the company is worth right now, given everything they know right now. Good news comes out, more people want in, the price goes up. Bad news comes out, people want out, the price goes down. The company itself might not have changed at all, but the perception of its future changed, and the price follows perception, not reality. At least in the short term. In the long term, though, the price follows the actual business. A company that keeps making more money will, over enough time, see its stock price rise. That gap between short-term noise and long-term signal is one of the most important things in all of investing. The second vehicle is bonds. A bond is the opposite of a stock. With a stock, you're an owner. With a bond, you're a lender. You are handing your money to a company or a government and saying, "Here, use this, and pay me back later with interest." It's an IOU with a schedule. They tell you exactly how much they'll pay you and exactly when. Bonds are calmer than stocks. They don't jump around as much, but they also don't grow as much. You're trading excitement for predictability. You're the bank. They're the borrower. The interest is your profit. The third vehicle is index funds and ETFs. And this is where it gets interesting. An index fund is what happens when someone says, instead of picking one slice of pizza, what if you just bought the entire pizzeria? An index fund bundles hundreds, sometimes thousands of stocks into a single package. When you buy one share of an index fund that tracks the entire market, you're buying a tiny piece of every major company at once. You don't need to pick the winner. You own all of them. The ones that fail get replaced. The ones that succeed pull the whole thing up. And the cost of owning this package is almost nothing, often less than 0.1% per year. This vehicle, more than any other, changed investing for normal people, because it meant you no longer needed to be an expert, you just needed to show up. The fourth vehicle is real estate. When you buy property, you're buying a physical thing that people need, a place to live, to work, to shop. It produces income through rent, and it tends to grow in value over time. But real estate has a superpower that other vehicles don't. Leverage. You can pay $100,000 and control a $500,000 asset. If that asset goes up 5%, you didn't make 5% on your money. You made 25% because the gain is on the full value, not just your piece. That's leverage. It's powerful going up. It's equally powerful going down. And if you don't want to buy a whole building, you can buy a rate, which is essentially a tiny slice of a real estate portfolio that trades like a stock. Same principle. Ownership. Just in a different wrapper. Those are the 4 vehicles. Stocks, bonds, index funds, and real estate. Every investment product you've ever heard of, mutual funds, hedge funds, target date funds, robo-advisors, all of them are just different combinations of these four things in different proportions. Once you see that, the 500 options on that screen stop being terrifying. They're all just pizza slices in different boxes. Now here's what the strategy does. The strategy answers the second question: why does doing less almost always beat doing more? And this is the part that breaks most people's brains, because everything in the rest of your life rewards effort. Study more, get better grades, work harder, get promoted, practice longer, play better. Investing is one of the very few areas in life where the person who does the least often wins. The first principle is time, not timing. Time. There is a difference so large between these two words that it explains almost every dollar most people leave on the table. Timing means trying to figure out when the market will go up and when it will go down, and jumping in and out at the perfect moments. It sounds smart. It is nearly impossible. Study after study, decade after decade, shows that even professionals who spend their entire careers trying to time the market fail to beat it most of the time. Time, on the other hand, means something much simpler. Put your money in. Leave it there. Wait. The longer you wait, the more the compounding engine works. An extra 10 years of time in the market is worth more than doubling your monthly contribution. The market goes up and down in the short term. Over 20 or 30 years, it has gone up every single time in recorded history. Time is not a tactic. It is the single most powerful force in all of investing. The second principle is diversification. Don't put all your slices in one pizza. If you own 100 companies and one of them goes bankrupt, you barely feel it. If you own one company and it goes bankrupt, you're wiped out. Diversification is not about being cautious. It's about being mathematical. The more you spread out, the more your outcome tracks the overall economy instead of the fate of one company or one sector. And the overall economy, over long periods, goes up. You're not picking winners. You're making sure you can't lose the whole game. The third principle is cost. Every fund charges a fee. Every advisor charges a fee. Every trade might have a cost. And here's the thing about fees. They don't feel like anything. A fee of 1% sounds like nothing, but over 30 years, a 1% annual fee eats roughly 25 to 30% of your total wealth. That's not a rounding error. That's a quarter of everything you built, gone, paid to someone for managing your money in a way that, statistically, probably didn't even beat the market. The cheapest index funds charge less than 1/10 of 1%. The difference between those two numbers, over a career, is the difference between retiring at 60 and retiring at 67. The fourth principle is consistency. Invest the same amount every month. Automate it. Don't look at it. Don't react to headlines. Don't check your portfolio every day. The people who perform best in the stock market are the ones who forgot they had an account. That's not a joke. That's a real finding. Because every time you look, you're tempted to do something. Sell this, buy that, switch to the hot thing. And every time you do something, you're likely to do worse than if you'd done nothing. Trying to pick the perfect stock is like switching lanes in traffic. You burn energy, you stress yourself out, and most of the time, the lane you were in was moving just fine. Now here's the part most people never see. The vehicles and the strategy look like two separate things. One is about what you buy, the other is about how you behave. But they're not separate at all. They're the same insight, seen from two directions. Look at what happens when you combine the simplest vehicle with the simplest strategy. The simplest vehicle is an index fund. You buy everything. You don't pick. You don't analyze. You just own the whole market. The simplest strategy is to invest consistently, keep costs low, and wait. Don't trade, don't time, don't tinker, just wait. Now notice something. The reason the index fund works is the same reason the strategy works. Both of them succeed by removing you from the equation. The index fund removes your stock picking. The strategy removes your market timing. The instrument is simple because it doesn't need your input. The behavior is simple because it doesn't need your intervention. They're not two advantages. They're one advantage. The same force that makes the best vehicle boring is the force that makes the best strategy boring. And that single force, the power of getting out of your own way, is what beats 90% of professional fund managers year after year after year. Investing well is not about being smart. It is about being patient with something simple. The moment you truly understand that, the cockpit stops looking like a cockpit. It's just a pizza shop, and you only need one slice. Here's what most people get wrong. The first mistake is thinking you need to know a lot before you start. You don't. You need to know the difference between a stock and a bond, what an index fund is, and how to set up an automatic contribution. That's it. Everything else you'll learn along the way. Waiting until you feel ready is the most expensive decision you can make, because every month you wait is a month of compounding you'll never get back. The second mistake is thinking investing is for people with a lot of money. It's not. You can buy a share of a global index fund for the price of a meal. The amount doesn't matter nearly as much as the habit. Someone who invests $50 a month for 30 years will almost certainly end up wealthier than someone who invests $5,000 once and never does it again. The third mistake is believing the secret is picking the right stocks. It's not. The secret is owning everything, paying almost nothing in fees, and waiting. The people doing the most research, making the most trades, and paying the most in fees are, as a group, the ones who earn the least. The vehicle and the strategy are one thing, and that thing is simplicity. The fourth mistake is selling when the market drops. A market drop is not a loss. It's a sale. You only lose money if you sell at the bottom. The market has crashed dozens of times in the last century. Every single time it recovered and went higher. The people who sold during the crash locked in their losses. The people who stayed, or better, kept buying, came out ahead. Panic is the only thing that turns a temporary dip into a permanent loss. Let me show you exactly how this knowledge is useful right now. If you've never invested before, the single best first step is to open a brokerage account and buy one share of a broad index fund that tracks the global or total market. Not 10 funds. Not a portfolio. One fund. You can do this today with almost any amount of money. If you already invest but check your portfolio constantly, try this. Set up an automatic monthly transfer into your index fund and delete the app from your phone for 6 months. When you come back, you'll almost certainly have more money than if you'd been watching and tweaking. If you have money in a fund your bank recommended years ago, check the expense ratio. If it's above 1%, you are paying thousands of dollars per year for the privilege of probably underperforming the market. Switch to a low-cost index fund, and that money goes back in your pocket. If the market just dropped and you're scared, do not sell. Open the app, look at the red number, close the app. That's it. The red number is temporary. Selling makes it permanent. If you're young and retirement feels impossibly far away, that distance is your single greatest asset. Every dollar you invest in your 20s has 30 or 40 years to compound. Starting 10 years earlier with less money beats starting 10 years later with more money. Time is the cheat code, and you have more of it right now than you ever will again. Here's what you now know. Investing is ownership. You buy pieces of things that create value, and you hold them while they grow. There are only 4 vehicles, and every product in finance is a remix of those 4. The strategy that beats almost everything is the simplest one. Own the whole market, pay almost nothing, and wait. The 3 most practically useful ideas are these. 1. Investing is not gambling. It's buying pieces of real businesses, real loans, and real buildings. The moment you see it as ownership instead of betting, the fear goes away. 2. Time in the market beats everything. Start now with whatever you have, and let compounding do the work. 3. The simplest vehicle and the simplest strategy are the same advantage. Doing less with something boring is the one approach that consistently beats the experts. You opened that app once and saw a screen full of numbers you didn't understand, and you closed it. Now you know what those numbers mean. And more importantly, you know you don't need most of them. Just one simple investment, with time. That's the whole game. This is education, not financial advice.